Hey everyone, welcome back to my channel Ananta Wealth Management. Today we are talking about something that affects millions of people worldwide, which is disability, and why having disability insurance is so crucial. I'll be sharing some insights. So let's jump right in. First off, you might have heard that about 10% of the world's population has some form of disability. While some sources do suggest that figure, the World Health Organization estimates that closer to 15% of the global population lives with a disability. That's over 1 billion people worldwide. The differences in these numbers generally come down to varying definitions and methodologies used in studies. Now, let's zoom into the United States. According to the data from the US Census Bureau and the Centers for Disease Control and Prevention, roughly 56 million Americans, that is about one in every five, have some form of disability. These disabilities can range from mild impairments to conditions that significantly impact their daily life. And when we talk about severe disabilities, the numbers are still striking. Approximately 38 million Americans, or about 1 in 10, are living with severe disabilities. This figure is supported by the data from the American Community Survey from Census website, which highlights the challenges that a significant portion of our population faces every day. So, why does all this matter? And why am I talking about this so much? This is where disability insurance comes into play. Disability insurance offers essential assistance and protection if you ever become sick, injured, or otherwise unable to work. It provides income replacement to help cover your living expenses, medical bills, and other financial obligations, ensuring you are not left struggling during those tough times. And here is another important point. As we age, the likelihood of experiencing a disability increases significantly, right? That's why it's important to plan ahead and consider disability insurance as a key part of your financial strategy. It's not just about protecting your current income, but also securing your long term financial stability. Let's dig in and find out more about disability insurance. So, what does disability actually mean in the world of insurance? In disability insurance, how disability is defined can really affect your benefits because of two primary definitions: the own occupation definition and the any occupation definition. Let's analyze each definition with examples. Under the own occupation definition of disability, you are considered disabled if you can no longer perform the duties of your own occupation. Now, what does that mean? It means that if you are unable to do the job you currently have or the job you are trained for and skilled in, then you qualify for benefits. The great thing here is that even if you find work in another field, you can still receive benefits. This definition is especially favorable for those in specialized, high paying fields like surgeons or lawyers. However, because it's so beneficial to the insured, it also comes with a higher premium costs. For example, imagine Dr. Smith, a renowned neurosurgeon, earning $500,000 a year. If Dr. Smith suffers a stroke that leaves him unable to perform surgeries, even if he could work in a less demanding role, his policy would consider him disabled under the own occupation definition and pay out his full benefits. Now, let's explore any occupation definition of disability. According to this standard, a person is deemed disabled if they cannot perform the essential duties of any gainful occupation for which they are reasonably qualified by either education, training, or experience. In simple terms, if a person can secure employment that pays at least 60% of their former income, they may not be eligible for benefits. For example, consider a attorney earning 300K per year who develops a disease that limits his ability to talk. Under the any occupation definition, if he manages to find work as a consultant or a researcher that pays at least 180K, which is 60% of his previous salary, he would not be considered disabled. Let's talk about split definition. Basically, a split definition means the rules change after a while. Think of it in two parts. For the first 2 to 5 years, if a person can do their specific job, which is their own occupation, they come under own occupation definition. That means they are covered. So if someone is a surgeon and they can no longer operate, they would likely qualify as a disabled person during this initial period, which is 2 to 5 years, the first 2 to 5 years. But after those first few years, it gets tougher. The definition switches to any occupation from own occupation. This means they are covered if they can do any job. We understand this. They are covered, they are only covered if they can do any job, literally any occupation, no matter what it is. So, even if they can't be a surgeon anymore, if they could still work as, say, for example, a medical consultant or a medical assistant from home, they might not be considered disabled under this stricter definition. See, two definitions in one. Let's look at an example here. Debbie is a physician. Unfortunately, she develops a nervous disorder that stops her from seeing her patients. She can't do the core part of her job anymore, but she can still work from home in a related field. Uh, Debbie's disability policy has this split definition. It says for the first 2 years, because she can't see patients, she is considered disabled under the own occupation part of her policy. She is unable to perform her job, right? She is unable to perform her specific job. But after 2 years, the definition changes to any occupation. Now, even though Debbie can be a doctor in the traditional sense, she can still work from home and earn a good income in a related field. Because of this, the insurance company no longer considers her disabled. See, for the first 2 years, while she is considered disabled under own occupation definition, Debbie gets 70% of her original salary. Let's say she was making 300K per annum. 70% of 300K is 210K. Uh, so not bad, right? She gets 210K paid for the first 2 years. But after those 2 years, her benefits stop. Even though she still has a medical condition, she doesn't qualify under the any occupation definition. So Debbie's situation really shows how important it is to understand the exact definition of disability in a policy. That split definition can be a real game changer. It might seem great at first, but it can also leave someone without benefits down the line, even if they can go back to their original career. Definitely something to think about it, right? Let's dive into a crucial aspect of disability insurance that often gets overlooked, which is called as residual disability benefits. So, what happens when someone can go back to work but they can't earn as much as they used to be because of their disability? That's where this residual benefits come in. Let's explore this one. So, disability insurance is designed to protect income if a person becomes disabled and can't work. But what happens when they recover enough to return to work, but their earning power is reduced? Maybe they can't work as many hours or they have to take a lower paying job. This is where residual benefits become incredibly valuable. A residual benefit is a provision in a disability policy that kicks in when someone has experienced a loss of income due to their disability, even if they are able to work. So let's go through this again. So, residual benefit, it is a provision in the disability policy um, that kicks in when someone has experienced a loss of income due to their disability, even if they are able to work. So let's explore this further. It is designed to bridge that gap between their pre-disability earnings and their current reduced earnings. So how does that work? There are generally two ways insurance companies determine if someone qualifies for residual benefits. The first one is loss of earnings. The second one is loss of time or duties method. These are the two methods they use. The first method, loss of earnings method, is pretty straightforward. If someone's income drops by a certain percentage, let's say 20% or more, due to their disability, they're likely to qualify. The loss of time or duties method is a bit different. If their pay is reduced because they can't work the same hours or can't perform all the aspects of their previous job, they might also be eligible. Let's look into this example. Say Maria is a graphic designer earning 60,000 per annum. Unfortunately, she develops carpal tunnel syndrome, making it hard for her to use a mouse and keyboard for longer periods. She can't work full time as a designer anymore, but she can still do some freelance work, earning $30,000 per annum. So, $30,000 is exactly half of $60,000. Now, Maria's disability policy has a residual benefit provision with a 20% loss of earnings trigger. Let's see what happens. Maria's carpal tunnel syndrome limits her ability to work as a graphic designer full time. This is the first thing, right? The second thing is Maria is able to return to work part time but as a freelancer. Now, let's see loss of earnings. So Maria's pre-disability income was $60,000 and Maria's current income is $30,000. That's a 50% decrease in her earnings. Since her 50% income loss is well above the 20% trigger in her policy, Maria qualifies for residual benefits. Let's say Maria's maximum monthly disability benefit. Sorry, let's say Maria's maximum monthly disability benefit is $3,500. This would be based on a percentage of her pre-disability income, like 70% or so. Because of her income decreased by 50%, her residual benefit will be 50% of that maximum, which is $3,500. So she will receive half of that maximum residual benefit, which is $3,500, which is $1,750 per month. So at the end, Maria receives $1,750 each month, supplementing her reduced freelance income. So as you can see, the residual benefit helps Maria bridge that gap and maintain a more stable financial situation while she adjusts to her new work capacity. Residual benefits are a valuable part of comprehensive disability insurance plan. If anyone has any questions about their policy or are considering purchasing disability insurance, be sure to ask about residual benefits. And always consult a qualified financial advisor to discuss individual needs. Thanks for watching.